Hi, this is Eric Boyce, CEO and Chief Investment Officer for Boyce and Associates Wealth Consulting, and welcome to Charts and Chat for March 26th of 2023. Please see our disclaimer for important information. Well, the chart pack this week, we're going to start off with a heat map here, looking over the last several years, and then on the far right, you see a 10-year compounded average growth rate in returns for various sectors of the market. And so this is a tool that I'm going to use to help extol the virtues of diversification. So as you can see here, I mean, it's a mixed jumble of colors here. And really what it's intended to provide is a perspective that in any one given year, you could have different forms of market leadership. And I've shown this to you in the past. Over the last 10 years, you can see in the far right, U.S. equities have returned about 12.4%. And you see in that orange area is a 60-40 portfolio, which performed absolutely poorly last year with the record year that we had in terms of market losses last year. And you can go down the list, and I don't want to spend a whole lot of time on this, but the fact is that from one year to the next, there are different areas that provide leadership. And so, if you're going to hitch your wagon to the S&P 500 in 2022, obviously that would have not been favorable because you would have been at the lower end of the spectrum. Had you been in cash, you would have been in a lot better shape. However, if you'd been in cash 2019, 2020, you would have done rather poorly. And interestingly enough, in 2020, we had gold at a time where we were shutting down the economy and we had a pandemic at our feet. Performed exceptionally well, 24%. So again, this is why we have investment policy statements. This is why we have diversification. We do have ranges, so it allows us to manage within the market environment that's being dealt to us. But it gives us a long-term roadmap. And so, again, I want to caution people about wanting returns that look just like the S&P 500 because that can get you into a lot of trouble. Now, the idea here is that you have these durable investment policies that can survive different market environments that will lead to higher probabilities of success in your long-term financial plan. Now we'll talk about what's going on here in the market. And so, for a long time, we were talking about this quantitative tightening. The Fed was reducing its balance sheet. It was taking money out of the system. And then lo and behold, Silicon Valley Bank happened a couple weeks ago. And look where we are now. So the Fed's balance sheet, we basically have unwound about 70% of the quantitative tightening that we've done over the last year. And that's happened in really the last 2 weeks since Silicon Valley. Not very many people knew that there was a Silicon Valley Bank more than 2 weeks ago, but here we see it now. The Federal Reserve has created these lending vehicles. We'll see here in a second that a lot of banks have taken advantage of this, large and small. And so as a result, the Fed's balance sheet is now kind of re-expanded here from its trough point at the beginning of the month. And we're not quite to the peaks that we saw back in April of last year, but obviously we're heading in that direction. Here's a couple of charts here from the St. Louis Fed. Now, looking at all the numbers, they're relatively small. That's not really the intent of this slide, is to give you the raw data necessarily, but just show you directionally what's going on in this market. So the upper chart here is borrowings from small domestically chartered banks. And you can see here, that those borrowings were up $250 billion, again, mostly from the Fed. And then the middle chart there is cash assets at these same small domestically chartered commercial banks. And you can see that the assets have gone up. Cash reserves are up, but they're only up by $100 billion because these small banks in the wake of Silicon Valley, Signature Bank, et cetera, have lost assets. And where these assets are going is into money market mutual funds. They're going into the large money center banks, Chase, and Wells Fargo and Bank of America. So this is the issue with small banks right now is we need to kind of have a settling out, a calming effect, if you will. Fed is trying to do that with these these term bank funding programs and some of these other measures to try to help shore up confidence in the small banking sector. But we're still in a little period of tumult right now, and this chart is very much evidence of that. Here's borrowings at all commercial banks. So this includes not only the small banks, but also the large banks. And you can see the spike there. You can see that actually as the economy was in the midst of slowing, that those borrowings were actually picking up. Now, they had just reached a point of kind of like the trend line going back to 2017 when Silicon Valley happened. And you can see where those have spiked even beyond where they were at the pandemic when the economy was shut down and people needed emergency loans and such. Here's a chart from the Financial Times showing U.S. bank failures. And interestingly enough, we know that Signature and Silicon Valley Bank, these were two rather large and important, and obviously, as we found out after the fact, systemically important banks. And so those depositors were made whole by the regulators. But we can see here, going back to 1980, you see very clearly the spike. This kind of darker blue line represents Bear Stearns and Lehman by themselves, and very notable failures. And Lehman was basically liquidated for cents on the dollar, and Bear Stearns was acquired for a few dollars a share by JP Morgan back in 2008. But you can see here that the latest episode of bank failures, quote unquote, is actually significant. So, this is something that while we know that this is not 2008, it is something that we need to pay attention to. Here's a chart from Jason Furman in a Twitter feed of his that actually I tend to agree with. So you've got all of this tumultuous activity, and we'll show you in a second how things have changed literally in the last 2 weeks. This environment was totally different at the beginning of the month, where we felt like we were going to get more rate increases. We were going to probably push 6%, and now the band is 4.75 to 5% on short-term rates, and we thought we were going to get another full percentage point before we were done, and we thought that once the Fed got there, that they would kind of hold steady for a while. Well, that whole calculus has changed now, and you can see here the probabilities are rather stark when you look at that circled area that I did. That looking out at the end of the year, there's 60 to 70% probability of rates moving down by 1% to 1.25% from where they are now, and I think that's probably, given the fact that we still have this inflation that's a little bit sticky, that's a little bit of a stretch right now. But this is what the market's pricing in, so we have to be cognizant of that. But I would say that at this juncture, even though we have some of these risk factors out there, and we do see some slowing in the economy, that I think it's a little too premature to be building that much easing into the pipeline literally in the next 9 months. So here is that core PCE inflation. As we look at it on a trend line basis going back to the beginning of 2020, core PCE, personal consumption expenditures, is what the Fed looks at as their primary barometer for inflation, and especially at the core. And so you see here that it is coming down, but it is rather sticky. And so this is what has everybody in a funk right now about the pace of this. But as I used this analogy last week, it's just like if you leave for a couple of weeks on vacation and you turn your thermostat off, and you come back and you turn it back on, and you're not going to get to where you want it like at the snap of a finger. It's going to take time. But there's certainly enough tightening in the pipeline that if they were to pause now that they've raised 25 basis points in this last meeting, that I think you'll continue to see this inflation decrease manifest. Here's a quick look at the Treasury curve going back to March 8th. This is just before Silicon Valley broke. And you see March 20th. So obviously this is the 26th. So this is a few days old, but you can see the dramatic shift in that line from the beginning of the month. So we see here that the yields have come down dramatically, particularly at the 2 year. You look at that 5.1 to 4%, and that is an outstanding move in a relatively short period of time. You even see the 10 year. And there was a point there at the beginning of the month where we had the 30-year Treasury over 4%. We had the entire yield curve over 4%. But you see here that yield curve is definitely inverted. That meaning that that short-term rates are above longer-term rates. But you can see the dramatic shift that we've seen in a very, very short period of time. Here's a different way of looking at this futures curve for Fed funds. Now, we've told you that the expectation, that whole calculus has shifted in a relatively short period of time, and you can see that now. I mean, this is actually a little bit old. So this is before the Fed's rate increase of just this past week here, and so this data is a little bit old. But the upper boundary of that Fed funds, of the effective Fed funds rate, is about 5% now, 4.75 to 5. So that has moved up since this chart was developed. But the same story after the Silicon Valley Bank issue and some of these other things that have come to the fore. You can see where that expectations curve has really shifted. And now I'd say the update to this chart is now that green line, which is kind of looking at the Fed funds futures curve from last week, it is looking about 3.6 to 3.8 right now by the beginning of next year. And we'll look at speculator positions, a chart from Fidelity. So this is the U.S. Treasury yield for the 2 year maturity. And as we just identified to you in that yield curve chart, you see that dramatic shift going from 5.1% essentially to 3.7%. It's a shift that you rarely see. And the volatility in fixed income, which is another chart that we have to show you this week, will highlight just how odd and crazy the current environment is for bond volatility, much more so than stock volatility, surprisingly. So you see the net speculative positions in treasuries has really gone down and with these rate decreases. Here's a 10-year break-even inflation rate. So amidst all of this current market kind of unevenness and anxiety, if you will, if you look out over the long term, and the same really goes for the 5 year too, but more so in the 10 year, these are long-term inflation expectations. And so you see here that number has been really, really consistent outside of the pandemic and outside of recessions. It's really hugged in that 2 to 2.5% range. Well, here's a situation that you don't see that often. So this is where we have essentially the Fed funds rate, the lower boundary. This is after the Fed funds rate was increased at the last Federal Open Market Committee meeting. So we've got the lower bound at 4.75, and we have the latest reading of core PCE, which we were just talking about, at 4.71. So we actually have the Fed funds rate above core inflation, as the Fed likes to define it. And so what's interesting here is that when we see this, there is usually a rate decrease that follows in fairly short order, which I think, we've talked about already a couple of times, I think is probably in the cards if we continue to see economic slowing. However, I just don't think that I'm willing to budget about almost 1.5 points of rate decreases over the next 9 months. I think inflation is just too high at this point. But all this chart really tells us is when we see this inflection point, that we're apt to see a rate decrease in fairly short order. Well, we're going to talk about some lending standards here, and this focuses on the consumer side of the ledger. And we have the next chart, which will highlight also the commercial side. And we see here that anything above zero represents tightening on the part of lenders. And we see, whether it's credit card, auto loans, or any other kind of unsecured loans at the consumer level, that we do see tightening. And this type of tightening is consistent for the most part with recessionary periods. And so when credit gets tight, obviously the velocity of money slows down. You have it will be disinflationary because you won't have as much money chasing fewer goods, so to speak. So you'll take some of the mother's milk away from the inflation side, which is, again, is all kind of what we want to help drive inflation down. But I just wanted to show you this, that the consumer side is clearly slowing down from a credit standpoint. Well, here's another chart from Charles Schwab, which overlays in the amber line the C&I loans. Those are commercial and industrial loans. Think about working capital, think about capital spending, working lines of credit, those types of things. You can see this also being overlaid with the bank's willingness to make consumer installment loans, and think about, like cars, think about, everything that we saw on that last chart. And this time series goes back to 1966, and you can see whenever you see those spikes and again, this is an inverted curve, so these spikes represent like a huge contraction in the willingness to make consumer installment loans. So in the blue line, when you see this thing pop like it does, that's a sign of credit tightening, and you can see that when it spikes like that, it's very consistent with these recessionary periods. And then the time series for C&I loans began roughly about 1990 here, you see. Same deal. So you see when these credit standards are being tightened, you tend to correlate that with recession. Here's a chart on something that I believe that the market is going to refocus on, and we've kind of lost sight of this in the wake of some of these banking issues that we've had over the last several weeks. But we do know that we're going to hit a debt ceiling, and we're going to have to increase our borrowing limit. And there's a lot of contention in Congress right now about that. And so there's an increasing feeling here that there's going to be some type of a debt default. And obviously, we're going to want to monitor this very closely. But this is the credit default swap rate on essentially 1 year U.S. sovereign debt. And so again, not to, I honestly do believe that this is going to get worked out, but I do think, as it always tends to be, it's going to be an 11th hour issue. And on this slide, we have economic policy uncertainty. You can see how this has oscillated over time, going back to 2007. You see the impact of the pandemic and shutdown. And over the last couple of years, we've kind of oscillated within a band. And so lately, we've seen a little bit of an uptick in that. But it's not at crisis levels now. So economic policy really kind of relates to intuitively what you think it would be. It's like, we don't know, obviously, about the debt ceiling. We don't know about inflation. We don't know about banking regulation and how that's going to help shore up and kind of prevent additional banking crises. So we do see a slight uptick in economic policy uncertainty, but it's not nearly at a crisis point that we would typically correlate to. There's a chart that I thought was really interesting that shows rate tightening cycles over time. And, amidst the backdrop of Silicon Valley Bank and Signature Bank and what we now know, Credit Suisse, and then now there's more speculation being put on Deutsche Bank, which ironically is one of the contributors to this chart. But we see during these prior rate tightening cycles that it usually is tied into some type of a credit issue. And you can see going back into the 70s, the UK secondary banking crisis, and then 80s, early 80s, you had the Latin American debt crisis when rates were going up, and then you had Mexican peso, and you had the Asian crisis when rates were going up. And then, so there's usually some type of issue that tends to happen when you have these rate increases. And as we saw last week, the rate of increase in short-term rates has been much more dramatic over the last 12 months than it typically is in a rate tightening cycle. We've seen much more acceleration in rates, which, as we know now, has led to kind of a real problem with crypto, Silicon Valley Bank, and some of these small to medium-sized banks that were not, frankly, managing their balance sheet as well as they should have. And as we also now know, that the regulators in supervision weren't paying as much attention to what was going on in their balance sheets as they probably should have. But just to highlight here that there's when you get these when you have these rate tightening cycles, that it usually ties in and leads to some type of a market dislocation. Well, we've had 11 consecutive months of monthly leading economic indicator declines, 11 straight months. So we're almost at a full year's worth of declines in the LEI. And so you see here in these prior episodes where we have pronounced and consistent declines in LEI, that you typically have recession. So again, this is kind of all corroborating some of the other data that we've looked at. Certainly not afraid of recession. In fact, the sooner we get to it, honestly, the sooner we'll be able to get to the next economic cycle. And we won't know for a while if and when we're in recession. I think the probabilities have probably increased that we will be in recession after the Silicon Valley, and I think more so because of the effect that it had on credit tightening, which we just saw a few slides ago. I think that coupled with money supply, although with increased Fed balance sheets, that money supply has probably picked up a little bit, but it's still pretty slow. That that those two things will help to drive economic activity lower and again get us kind of level set for the next economic cycle, upcycle. Well, here's another chart of the LEI, and kind of looking at it differently. The last one was the number of consecutive months of negative LEI, and this is the actual year-over-year change, and you can see that overlaid with recessionary periods, and you can see that it lines up pretty well. And so we were in decline in the LEI even before the pandemic. So we were apt to have a bit of a slowdown, and it just got accelerated because of the shutdown. Now we've rebounded. Now we're trending lower, and so this is again very consistent with recessionary periods. It's an interesting chart that I saw, I believe, from Liz Ann Saunders of Charles Schwab, showing you that 800 companies. So we've talked about the job market at length here, and we've talked about the Challenger Gray layoff survey, which tends to focus on larger companies, and we see here that 800 companies have shed almost 500,000 jobs in this most recent downturn. You see technology accounts for a big chunk of those, but also consumer discretionary. Again, areas that you would normally expect in an economic downturn to be shedding jobs. But you can see here clearly that it's not just isolated to those two sectors. Here's a chart on new home sales. Now, amidst all of this negative data, and we have been talking about negative data in housing for some months, but oddly enough, we have 3 consecutive months of new home sales, which is very interesting. You can see that here. And the February reading was actually positive when it was supposed to be negative. And so we also see median new home prices are up 2.5% year over year, not a sign of like intense worry or trouble in the housing market for sure. Here's an interesting chart on energy, something that caught my eye. With the Russian invasion of Ukraine, we saw a pretty strong price response in crude. But if you look at it on balance over the last year, crude prices are actually down, and natural gas prices are down. European natural gas prices are down even more, which is really, really interesting, considering the geopolitical risk that existed a year ago and actually continues to exist today. Here's a quick look at the Kansas City Fed. This is from Liz Ann Saunders off her tweet, and I just did an excerpt here. Um, so, we actually had a bit of an uptick. Again, we have a lot of negative regional data and have had for a few months. We've got the LEI, and we've got all these other indicators that are suggesting that we're maybe on the eve of recession. But looking at this, maybe not so much. Even though it's not necessarily a strong reading, it's not a weak one either. We do see employment picked up a little bit. The reading itself was better than expected. Work week is still contracting, but it was certainly not nearly as bad as it had been over prior months. Well, now we're going to talk a little bit about the stock versus bond market volatility, and you can see that we tend to have far less volatility in fixed income than we do in equities. Bond market volatility is in that light shaded color there, and you can see how that's really picked up since the failure of Silicon Valley Bank. Equity market volatility has picked up, but not nearly as much as fixed income volatility has. Quick look at the yield curve. We're in a channel right now. I think what this really tells me is that if rates are heading lower, then where we want to be is certainly in gold, and we certainly want to be in fixed income. And we probably are at a point now where we can really begin in earnest to maybe extend duration out a little bit, increase our average maturities to perhaps capture that additional upside appreciation potential with rates moving down for fixed income. And you can see here that we've got the 2 to 10 year yield curve that has actually mitigated somewhat, but had reached a peak or a trough point, I should say, not too long ago. But we see this channel building. Probably the next leg is down. Here's a quick technical look at stocks, and I'm not a technical analyst per se, but you can read the tea leaves here. So you've got these moving averages, the 50-day and kind of the slightly muted yellow color, and then in that red color you've got the 200-day moving average, which is as you would think, a much more smoothed out figure. And so those have converged, and the technical trend lines have intersected with no clear direction. And this is from Urian Timmer at Fidelity, and he makes the argument that stocks will likely have limited direction over the near term, and I would probably tend to agree. We've got to work out a lot of things in the news cycle. We've got debt ceiling issues. We've got we have the Ukrainian situation to a lesser degree, but mostly economic issues that stand to continue to make the equity markets a little directionless for the time being. Here's a quick look at S&P 500 valuation. And so we've been oscillating here as well. And you can see the range is, basically low 15 times earnings to 18 and a half times earnings. And I think the implication here from Urian Timmer, again at Fidelity, is that we're going to stay in this band, that we have pulled ourselves down from that upper range because interest rates have moved up in earnest. And I absolutely agree with that. So I do think that we're going to oscillate within this band for a while. And here we have an interesting slide. I've never seen this represented like this before, but it's basically taking the S&P 500 index price and dividing it by gold. And then of course you get a ratio here, and you can see that over much of the last decade it was moving higher, and then we've had a couple of these consolidation phases. This is a great piece from Urian Timmer at Fidelity. You can see heading into the pandemic that it was consolidating, and you can see here that this index went lower, which means that gold prices went up that year. And we know that 2020, we've already seen earlier in the chart pack where gold had a pretty phenomenal year that year. And then the ratio decreased as the S&P 500 index went up. And now we're in a new consolidation phase. And so, there is a thought here, if you're not going to get a lot of impetus from the S&P 500, if it's going to trade sideways and that the next leg here is down, then that would imply that gold is set to catch a bid, which we generally know if you're in a weaker economic position or if there's uncertainty or anxiety, that usually gold will catch a bid. So that would be the inference here. Well, in the last couple of slides, I want to draw a couple of historical parallels for you. And the first one kind of draws that parallel to 2008. And in the aftermath of Silicon Valley Bank, a lot of speculation over the health of the banking sector. Obviously, we went through that catharsis back in 2008. And so there are some pundits out there that want to draw that parallel to 2008. And so we see here is kind of an overlay, and this is normalized, taking the 2008 data, which is in the blue line there, and it's normalizing it as of October 9th of 2007. And then it's overlaying that index with more recent data dating back to July of 2021 to 2023. And you can see that there's a fairly remarkable overlay. I'd say probably about a 60% correlation, perhaps maybe 65, and then there's a break. And then we see here that the environment back in 2008 was a lot worse from a stock market perspective than what we're seeing right now. I think we're apt to kind of tread water unless there's some other shoe to drop out there. Feel like the Fed has taken some bold steps to inject some confidence, certainly inject a lot of liquidity into the system, but also to inject indirectly some confidence in the banking sector. But again, unless there's a shoe to drop, best case scenario, or base case scenario, I should say, is that stocks kind of tread water for a little while. But that's clearly at odds with what happened in 2008, because we saw that the whole environment, the literal crisis of confidence in the entire financial system begin to erode. And we don't have that now. We're not anywhere near that. Volatility levels, even though they're pretty high on the fixed income side, are certainly not high on the equity side, and are not absolutely high overall. Nothing like we saw back in 2008. And there are a lot of people that may be listening to this that you really don't have that much recollection of 2008. Maybe a little bit younger, kind of like remember the headlines, but don't remember kind of the visceral nature of it. But having been through that, and then obviously 2001 before that, 98, and then the recessions back in 1990. I mean, we're not at those levels right now. So while if you can probably find a point in time where you could draw these parallels between these two markets, but at some point you're going to have a break. And right now the market's clearly not nearly as bad as it was in 2008. For our last slide of the day, we're going to have a little bit of a historical reflection as it relates to the debt ceiling crisis. So this is back in 2011, so it's about a little bit more than 10 years ago. And really the purpose of this slide is to show you that when you have kind of like heightened levels of legislative stress, that being whether the debt ceiling is going to be raised so that we can continue to fund our government, you can see that it has a noticeable but somewhat temporary impact on the markets. And so this is a look from FS Investments in one of their recent research pieces that shows you the stress in the market, basically coming off of about 1,350 on the S&P 500. You can see that it went down to about 1,150, so about 200 points off of the S&P 500, but it regained its ground really within the next month or two. Now, having said that, you've got 10-year Treasury yields which followed suit, and they also went down. And so this began a long slow march of rates down over the ensuing few years, but really not, not as important in this particular study. I just wanted to highlight primarily the fact that if we get to an impasse, an absolute impasse on the debt ceiling, you would expect to see some additional stress in the markets. And of course, that's a known unknowable right now. Don't think that any politician wants to try to go to the polls being a part of a group that stonewalled the ability for the government to fund itself and contribute to an economic slowdown. But just having said that, there is some speculation out there that the sides are very far apart, and this could turn out to be something that we'll have to deal with in a couple of months. But again, just drawing a parallel now for the time being. Well, that's all we have for the chart pack this week. Hope you've enjoyed it, and hope you have a great week, and we'll talk to you again soon.